And this was 2015, 2016. And there were three pressures that were brought to my attention. One was that the tech ecosystem outside of banking is evolving far faster than the technical capabilities inside of banking. And so banks in that era were running mainframes. They were running banking cores. They were struggling to do things like issue debit cards quickly. They couldn't make use of a lot of the new payments infrastructures. The second thing was the people in those banks were getting older. And the third was they were getting new customers. And the example that was given to me that has just blown up and is so fascinating is that's right around the time the Starbucks app came out. And so I'm sure a lot of people here have the Starbucks app on their phone. Do you know how much money Starbucks has sitting in the Starbucks app in all of our little $20 deposits? Anyone, shout out a number. I want to hear a couple of guesses. How much do you think is in the Starbucks app right now? $23.5 billion. These two guys right here. So you guys work for Starbucks, I'm assuming, right? 23 billion. Okay, so think about what that means in terms of the balance sheet of Starbucks. Starbucks is now its own bank. They never have to borrow a single dollar ever again. If they want to build 1,000 stores, that's probably a rounding error in that balance sheet, right? There's never going to be a run on the Starbucks app. And if there is, they live outside of the regulatory system, so who cares? That's their logic, right? And that was just the beginning. This was 6 years ago. This was after PayPal had gotten to a degree of maturity. This is before Bitcoin became something we all know far too much about, even though we don't want to. This is a moment where I said, okay, we need to do something. So I started a tech company to specifically try to streamline some of this and remove some of the friction in the banking system. And because of that, I got very close to basically the whole ecosystem. And so I got to know the guys at FIS and Fiserv and Jack Henry. I got to know a lot of the fintech ecosystem. I got to know a lot of the venture capital guys. And what I discovered was we were investing, roughly speaking, $40 billion a year in that era to build new technology for the banking system, 80% of which was designed to fix broken technology that was already in the system and not actually do new and interesting things, not build new digital experiences, not do a better job at AML or BSA. Okay, so that's 2015, 2016. Let's cut to last year when I was head of innovation at FDIC. So my job working for the chairman was basically solve that. That's literally what she said to me when she recruited me for the job. I'm like, okay. Digital asset depository base, if you normalize the math out to look exactly like how we think about deposits in the banking and credit union space. Roughly speaking, 87 trillion in deposits in the United States. It's kind of the number. 2 of it in credit unions, 2 of it in crypto, and the rest in banks. Okay? That number has gone up tremendously. Do you know where the 2 trillion in crypto is coming from? It's not coming from the credit unions. It's coming from the banks. So if you have not grown at the rate that new capital has been injected over the last few years, then you're all of a sudden on your back foot a little bit. And I hope some of you walk out of this conversation and realize that steady state might not actually be success here. I'm going to look to community banks over the next 18 months to grow. And I'm going to look at the ones that are growing outsized relative to new capital and outsized relative to crypto as new capital, not value, right? I think it's 5% of the market that's going to be able to do this. Because I think we're going to lose another 1,000 banks in the next 3 years, 4 years. And I think we're going to lose half of them in the not too distant future. And I think it's going to be state chartered institutions that are going to get hit worse. And so to me, this is a great time, but it's also, kind of buckle up, right? Because there's a lot of change that has to happen. There's a lot of activity that has to happen because if you're a small business oriented institution, doesn't matter if it's crypto Web3 or traditional fintech, they are all coming for small and mid-sized business, especially lending. That is where everyone is putting energy and balance sheet. And I'm not talking about trivial amounts of money. I'm talking hundreds of billions of dollars to try to get into this. You're seeing alternative to traditional mortgage structures. You're seeing short-term lending. You're seeing cash flow lending. And as community banks have to evolve from geographic to affinity-based. So if I say affinity, you guys know what I mean by affinity. It's like a self-identified group, like I'm a restaurant worker, I'm a tech guy, or something. It's like the community I put myself in that has nothing to do with geography, right? Some community banks are doing really interesting stuff. There's this one in Missouri that's decided to be like the restaurant community bank. So they want all the restaurants to use them. They do the mortgages, they do the loans to redo the kitchens, but then they also have a retail function that allows the people that work in the restaurants to get tipped out at night. And then the paychecks stay inside the bank. And they've created this really cool little closed ecosystem. That's the place where community banks are incredibly well positioned to beat these fintechs at their own game. You've just got to kind of act on it.